Right, welcome all of you to this debrief for those preparing for your AFM Advanced Financial Management exams for the December sitting. By this time, I hope all of you are ready. You've taken time to go through what you've studied in class. You're going through the various questions in the revision kit, but more importantly, you're also practicing on the revision platform. So we'll look at the pre-December 2025 mock exam for Advanced Financial Management. And some things that you must know by now. Number one is issue of time management. It's very important that you manage your time in the exam quite well, because most of the students, the risk they face and the challenges they face most times is how they manage their time. You find that students only attempt only one question or two questions, and that makes it very difficult for them to pass. Number two, by this point, you should be having at least fair knowledge of the exam areas that you should have covered in your normal class. You should have gone through investment appraisal. You have proper idea. You should have gone through mergers and acquisitions. You should have gone through the various techniques of risk management, but also you should be having a thorough understanding of how businesses are restructured so that you can generate value for the shareholders. I always advise students that your exam by now, you must know that it has two sections. Section A that has one question that carries 50 marks, and then you have section B where there are two questions each for 25 marks. And these questions are all compulsory, so that will give you the additional 50 marks. But I always advise you that it's preferable that you start with section B, because the questions in section B are more straightforward and less cumbersome. And if you look at this exam that we have here, we have the first question, section A. This question is called TEGAD, AI Solutions. And you can see that the number of exhibits are, you have Exhibit 1, Exhibit 2, Exhibit 3, Exhibit 4, and Exhibit 5. While if you go to section B, if I just go quickly to section B, you'll find that we have just two questions. The first question is this one. It's called Shikam, and you can see there are just three exhibits. If you go to the next question, question number 2, it only has 2 exhibits. So you can clearly see that the questions in section B are much shorter and more straightforward than the question you'll find in section A. So I always advise students that please always start with section B questions, because they're short, brief, and you can easily work through them. The challenge with section A in most cases is that there are a number of exhibits, and sometimes a student may find a difficulty, which makes them start to panic. All right. So what we shall do, but for purpose of this debrief, I'll just go through section A first, then I'll go to section B, and then we shall finalize like that. But like I did say, it is very imperative that by this time you are well prepared. The challenge that students face is that they don't prepare well, and then towards the end they start panicking. You must go for the exam when you're well grounded in the various aspects of the syllabus. You must know very well the aspects of the syllabus. You must know how to work through the various scenarios. And by this time, you should be comfortable to take the exam. So we shall look at section A, the first question, which carries 50 marks. But please remember that in your exam, you have up to 20 marks available for professional skills. So the examiner is testing you not only just on the technical skills that you will teach in class, but also on your professional skills. And in section A, there are 10 marks available for professional skills. In section B, equally, there are 10 marks. For each of the two questions in section B, you'll have 5 marks for professional skills. What are these professional skills we're talking about? Number one, examiner is testing whether you know how to analyze. Number 2, whether you have professional skepticism. Number 3, whether you have business acumen. So these are some of the things that the examiner is always looking for. But quickly, let's start with our section A question here. Now, I assume that you've read through the exhibits. The first exhibit, number 1, just talks about the company. Now, for most students, you should have practice on the platform, because it will make it easier for you. And this platform has a number of tools that you can use. You can cross, you can highlight. But the first exhibit just talks about the company. This company is called TEGAD AI Solutions, and I'll just highlight that quickly for you to see. What do? They deal in artificial intelligence. All right, they are pleased about the success of the company. That information is provided there. Just briefly about the company. Then the next is the investment they want to do. The investment is called, the board has decided that there's a lucrative investment which will require, and then a consultancy that cost them 120,000. So this is an example of a sunk cost. But if you read through the question, you will have known that at this point they tell us that if you go to the firm has identified the nation of Necos. destination of NECOS, where they want to undertake the investment. So you read through those details as they are provided. Then we have exhibit number 3, which looks at the projected financials and investments that are required. Number 4 is taxation and other financial information. And then lastly, number 5 is the offer from tech. Now, what I always recommend to students is that even before you go through the exhibits, the first thing you do is to go to the requirements and see what are you required to do in the requirements. That will give you an idea so that your brain is fixed. So in this example, you see that if you go to the requirements, you have 2 requirements. You have Part A, which talks about international trade tariffs, benefits and drawbacks. And then Part B is talking about getting the value. So at this point, you can realize that this question is about investment appraisal. But there are very many aspects of investment appraisal that we looked at, or that you must have covered in your class. That investment appraisal looks at just the basic investments. You have international investments. You have real options. You have financing effects. So you must know which area of investment appraisal the question is about. Now, if you recall, we did something similar to this in class. I think I'll remind you there's a question called CHUMRA. I'll just quickly look up our class notes previously. Just give me a second. Just take you through the class notes. We did a question on international investments called CHUMRA. Here it is. So if you've read this question, what you have here in your mocks is simply a clear example of what we did in class. What do they want us to do? They want us to evaluate the value of the investment that the company wants to undertake. They want to get the value of the NACOS investment. So you must understand, what is this investment about? This company has identified a nation called NECOS where they want to undertake an investment. The details of the investment have been provided, and it's looking at this as a prime opportunity for the company. So, and I think this will give them strategic advantage of being what? An early entrant into the business. Financial projections are provided here. You can clearly see what is required in terms of investment. You need premises, you need equipment, taxation matters that are provided, details of the revenues and working capital equally what? Provided. And then, of course, additional costs are also provided. Taxation is also given in the certain information that you can see that in the country where the company is located, they're charging tax at a lower rate of 17%. And then where the investment could be undertaken, which is NACOS, tax is being charged at 25%. The cost of capital is 12%, and this is applied to dollar cash flows. Now, when you read through this question, what you should realize immediately is that this is an international investment. So this is an international investment. So therefore, your mind should be able to start now thinking that, what do I do with international investments? But quickly, let me just go through the requirements and just talk through them quickly. The first part of the requirement, of course, we start with the easy marks first. They're just trying to examine, asking you to explain the purpose of international tariffs. So by this time, we have talked about international trade. We talked about the World Trade Organization. What do they do? So here, they're simply asking you, what are the purpose of international tariffs? So most countries, of course, will put tariffs just make sure that they protect their home industries. But also, some countries use them as a means of revenue or income. And sometimes, of course, this is not good because it stifles free trade, and that's why most countries will try to remove these tariffs. So you'll be asked to discuss the benefits. What are the benefits? Of course, if you remove tariffs, it simply means that you increase the international investments into the country. But at the same time, as you bring in foreign investors, there will be a possibility that they will affect the local investors. So this part we had covered it earlier on. So this should not be an issue for you to be able to discuss the benefits and drawbacks of removing tariffs. But I'll put emphasis on the next part, Part B, which talks about writing a report for the board. Now, like I did say, is that your answer sheet has 2 parts. You have the word processor, and then you have the spreadsheet. So in the word processor here, you must be able to know the proper report format. Remember that the professional marks that the examiner will give you, 10 in this question. So you must know how do you write a report. So you must know from, let's assume, the consultant, The report is going to, let's say, the board. What is the subject? And then, of course, by now, you know the general report format. You have an introduction paragraph just to highlight what you want to talk about. You'll have the discussion on the key issues. And then we shall have, of course, our conclusion. And don't forget that our annex will be our working note, Excel. So this is how we shall outline our report. And it's very important that at this point you have an idea. And I'll just highlight here the key issues. I'll just use bullet points for now, just to make it easier for you. I have our part A, or rather part 1. This is just to make it easier for you to follow through. You can have part 2 of the discussion. You can have part 3 of the discussion. You can have part 4 of the discussion. And of course, lastly, we'll have our conclusion. So don't forget this format. All right. Now going back to our spreadsheet, make sure that you're comfortable using this spreadsheet. This is just a simplified version of a spreadsheet, simplified for Excel. Most of the functions are not there, but it should be very easy for you. So if you come back to the question, what they want us to do, if you go to the requirements, is the value of the project. What is the value of the project? So here simply, they're asking you about the NPV. So part A, if I come back to word processor, part A, so quickly I'll just talk about this. So part A wants us to get the value of that, of the project. And this is an international investment. So you must know how we evaluate international investments. We said there are two methods we can use to evaluate international investments. If you recall, we can use method 1 or method 2. Method 1 simply means that I'll get my cash flows in foreign currency. Like that. And what I will do is to convert them from foreign currency into local currency. So this will be converted from foreign currency to local currency. And to convert them, we shall use the appropriate. I am going to do this in Excel just for you to see, but you can do it. I'll use the normal Excel, just make it easier for you to follow through. But remember, you must be comfortable with this spreadsheet format. So I'll just simply come back here in our normal Excel, if you don't mind. So I'll just say, what B, what we want to do is to get the value of the project. Now, by this point, you must know how to get value of a project. International investments, there are two methods. We can use method 1 or method 2. So you can either use method 1 or method 2. So you must know when I use method 1, when I use method 2. Method 1 is used in most cases if you're given the cost of capital in local currency. And in this case, our local currency is what? US dollars. Method 2, in most cases, is used if we're given the cost of capital in foreign currency. For purposes of our exam here, the foreign currency in this question, just a second. The currency that we have here in foreign currency, just a second. If you come here, if you go to financial information, there it is. The currency that they use in NAPOS is called just a second. The currency is abbreviated as NK. I was just looking for the right name. It's called the NACOS krona. I was just looking for this. That's the currency, NACOS krona. All right, so our foreign currency, in this case, is the NACOS krona, abbreviated as NK, and our local currency is, of course, the USD. So this is where our company is located. So the investments being done in the country called NACOS, their currency is NACOS krona, which is abbreviated as NK. So in this example, we've been given the cost of capital in local currency. So if you had seen that quickly, you'd have seen that the cost of capital. If I come back here to additional financial information, sometimes it's better you just close these so that you only open them as and when you need them. Right, the cost of capital is given as 12%, denominated in what currency? In USD. All right, so in dollars. So that means we shall use method 1 here. What is method 1? Method 1 simply means that I will get my project cash flows in local currency, which is what? NACOS krona. I'll need to convert them from NACOS krona into dollars by using the given exchange rate. And then I'll have project cash flows in. So I'll start with foreign currency, which is NACOS krona. Sorry for that. I'll then convert them from kronas into local currency, which is what? Which is our USD. Give us our project question in local currency, and then I will discount this one with the local currency cost of capital to give us our present value in local currency. So this is what we shall do. This is basically what we do in method number 1. Get the project cash flows in foreign currency, which is NACOS krona, convert them from NACOS krona into local currency, which is USD, and then discount those USD cash flows using the cost of capital, which has been provided as 12% for dollar-denominated cash flows. So what we need to do then is to determine how we get project cash flows. The way we get project cash flows has not changed. The same approach. You must know how to lay out your cash flows starting from year 0. So by now you might know how many years the project has. Start from year 0. So in this example, we have how many years for the project. We'll be given the projections. We have 4 years. So you simply come back here and say, I start from year 0 up to year 4. We then lay out our cash flows. This is the same like we do it every time. The way you lay out your cash flow does not change. Like I said earlier on, you start with the operating cash flows. How do you get operating cash flows? You must get the revenues. Revenues will be our working number 1. And how do you get revenues? Revenues basically will be our quantities given the times the price. We'll then less. In this example, we're given the sales quantities or what we'll be doing in terms of projections. Here they are. Application that they will develop. 9,000 in the first year, 14,000 in the second year, 28,000 in the third year, and then 22,000 in the fourth year. Those will be our application that they will develop. And these applications are going to be sold at the current selling price of 195,000 NACOS krona. Now, one common mistake students do is that this is the current selling price. So this is the price at year 0. This is the price at year 0. So simply means that at year 0, the price, selling price at year 0 is 195,000. That's the price. What do? You then inflate this price from year 1 up to the subsequent years. So simply inflate this price, and we've been given the inflation rate for selling price as 7% annually, and then 4% for development costs. So you simply come here and say, I get this, I inflate it by 7%, and I simply drag it across for the next 4 years. All right, so this will be our revenues. Then, of course, you'll have the applications developed or what you may call your sales quantities in simple terms, but this is basically applications developed. All right. The next item, of course, will be our development costs. Development costs we've been given. This will be working number 2. Development costs will then be working number 2. So by now you should be fairly know how to do our costs. It will be the same approach. You simply get the quantities you've developed times the cost per unit. And in this example, they've told us that for the development, we're told that the cost of development is how much each application is developed at 65,000. And this is the cost currently 65,000. So currently means that's the price at year 0. So we shall use the same approach and simply come and say development cost per what? Per unit. How much is it? Currently 65,000. And this is going to be growing at a rate of 4% annually. So we'll simply come back here and increase it by 4% and simply drag it across. And then, of course, you multiply with the sales quantities. All right. The next cost we have, if you read the question well, we have a cost relating to data handling by a third party, and this is going to charge how much? 7.5% of the selling price per application. So we shall have data handling, which is how much? 7.5% of our sales. So this will be simply our sales amount there, and then you multiply by 7%. So I'll just show this quickly, just to make it easy for you to walk through. This is just an outline of what you should do. 19, 14, 28. Let me just complete this. 9,000, 14,000, 28,000, 22,000. All right. So these are applications developed from year 1 up to year 4. So at this point, if you want to get the revenues, you'd have simply multiplied the 2. This is just a debrief, so I'm just walking through it very fast, just to give you a heads up on what you expected to have been done. So that is it. These have been your revenues appropriately like that. All right. And of course, you'll have applied the data handling cost at 7.5% of your revenues. So just put this as a negative, just to show that this is a cost. There you go. All right. Of course, once you're done with this, if there are no additional costs, you just make sure that there are no additional costs. Make sure that all costs have been covered. We have the development costs. We have the data handling costs. If there's no additional cost, then what we'll now go to is basically to determine our right. If there are additional costs, what we'll simply do here and then at this point is just simply at this point, what you can do is just simply sum this up and then determine your profit. I'll just simply sum this up. Just a second. we'll just sum this up here at this point, like that, to give us our profit. So I always prefer that you do the tax calculation separately. So we'll just list the tax. Now in this example, we're told that there's a tax treaty between the two countries. So that means we shall take the project tax. Project tax, if you come up with the information provided, where the project is located, the project tax is being charged at a rate of 25%, and where the company is located is 17%. So there's no additional tax at this point. So it will be simply less than 25% here tax. In the event that the tax rate would have been higher where the company is located, then there will be an additional charge on that. But in this case, we have where the company is located, tax is at 17, project tax is at 25%. So there will be no additional tax. And next you can do here is basically to add your tax allowable depreciation. So I always prefer that this is a separate working. May call this working number 3. So you must know how this is done by this point. So I'll just come and say this is tax allowable depreciation TAD. So you must know the format. Of course, we shall have our year, just to make it clear for you. We'll have the cost. We'll have the capital allowances provided, and of course, you'll have the TAD, the tax benefit on that, tax at 25%. So in this example, we've been told that TAD is at what rate? If you come back here, TAD is available, tax liability depreciation is available. So second, if you look for that. Right, tax liability is available on computing equipment at a rate of 15% reducing balance. So if you come back here, the computing equipment was 1.8 million NACOS krona. So basically come back here and say, so in year 0, we shall start up to year 4. So how much is this? 1.8 million that is available. Tax is at 10%, reducing balance. So at this point, this should be easy for all of you, really. It's not a very complicated example. 10%, simply apply that. It's reducing balance method. Don't forget that this will reduce going forward. And remember, in the last year, we will not charge capital allowances, but we have to determine the balancing charge. Basically, we shall look at whether there's a balancing charge or balancing allowance by comparing the disposal value at the end, and of course, with what? The tax value at the end. Of course, you charge tax at 25% of this across. So I'm just giving you just a brief because most of you by this time should be fairly comfortable with this because we have gone through this quite a couple of times. So we now have our TAD here. So this will make up our operating cash flows. And I'll just change the color shade here so that you see. And after that, you can then put in the non-operating cash flows, which is basically the investment outlay. Investment outlay in year 0. And the investment outlay in year 0 is made up of 2 items, if you recall from the question. They need 1.7 in premises and then another 1.8 in equipment. So you simply come and say premises and equipment. I'll just say premises, 1.7 million. All right, so I'll just put a negative here to see. And then we have equipment, which is 1.8 million. So that's the initial outlay. Of course, we also have working capital. And in this example, our working capital is not non-incremental. That means you put in at the start and the same figure remains till the end. In this question, the working capital has been provided as, if you come back here, you see working capital has been provided as how much? 250. All right, we have about 250, which would be here. Right. And these premises have, of course, a disposal value at the end. If you come back here, being told premises will have 1,200, and then the equipment will have how much? 700. So this will be 1,200 for the premises. And then for the equipment, we'll have an additional 700 coming in. All right. So this is what you would be expected to do. And this will give you, if you sum this up, you will then arrive at your project cash flows in foreign currency. So don't forget that our working capital has to come out at the end. This will give us our project cash flows in foreign currency, which is what? NACOS krona. Right. So this is what, and if I'm just to show this here, if I sum this up from this point, this is just to show you. So this is what I then bring in my step 1 above. If you come here, this will now come up here. Will now come and say the project cash flows in foreign currency as given in that working. We'll just come and link this up here, just to make it clear. I'll maintain here 0 up to here 4 so that you can see quickly. You'll just simply come and link this from down here. And these are not the full workings. This is just a debrief for you to see what to do. All right, so this is what we would have done. The next would be to get the exchange rate. So we've been given the spot rate. So here, of course, the examiner is testing whether you know how to get exchange rates. So we've been given the spot rate as, if you come back here, that right now the spot rate between the dollar and the dollar and the krona currently is how much? 110 per dollar. And the way this rate is quoted, it means the dollar is the best currency. So it's always important that you understand which currency is the best. So in this example, the dollar is the best currency because it has a ratio of 1. So the current exchange rate is how much? 110. So that's the current exchange rate. But we also must get the rates that will apply in the future. The rates that will apply in the future are what we refer to as our forward rates. So you must know how to get forward rates. So this will be another working for forward rates. Now, forward rates, if you recall, we can determine forward rates using a couple of methods. We can either use purchasing power parity theory that is based on inflation, or we can use interest rate parity theory. But look at the information the examiner has provided you and see which one is the best to apply. So in this question, we've been given information about the inflation, and the inflation in NACOS is where the project is located, 6.5, and where the company is situated, is how much? 2.5. So here, of course, because we have the inflation rates, we can then use the purchasing power parity theory. So we'll just come and say, use purchasing power parity theory. And according to that theory, our forward rates are equal to the spot rate times 1 plus HC divided by 1 plus HB. So you must know what is HC, what is HB. So in this example, we said the base currency is the dollar. So that means our HB will be, our HB in this case will be 2.5 and then 6.5 respectively. So this is 2.5%. And then our HC will be 6.5% respectively. So of course you can now apply this formula and say the spot rate is given as 110. So our spot rate is given as 110. So you can now determine what the forward rate would be in the future. A couple of ways you can do this. If you're not sure, I will just make it easier for you. Just say 1 plus this. I'll just drag this one down. Like that. So the in year 1, what the forward rate will be simply equal to will be the spot rate times 1 plus HC divided by 1 plus HB. So I do it like that. All right. In year 2, it will be year 1 times 1 plus HC divided by 1 plus HB. The same will apply in year 3. Year 2 times 1 plus HC divided by 1 plus HB. So this will be your forward rate. So you simply come back here and put in the forward rates like we have done there for year 1 up to year 4. All right. We then take them up like that. So we now convert from Napos krona into dollars because we're converting the base currency. You must know the rule. The rule simply says when you're converting the base currency, what do? You divide. So it will be, so we'll simply get this, divide by that. All right. So I simply drag this one across like that. And what do? The cost of capital is given as 12%. So I simply use my power factors. I'll put here 0, 1, 2, like that. So by now you must know how to get this in Excel. Of course, the table is also provided, but I strongly advise you use the Excel. So the discount factor in year 1, in year 0 will be 1. In year 1, it will be simply 1 plus 12% to the power negative 1. This will be your power factors when you discount. All right, so you simply drag this across and you have the discount factors. And of course, you multiply to give you the present values. And once you have the present values, the NPV or value of the project will be simply equal to the sum of the present values. So you simply come back here and sum up the present values. So this will give you your NPV. Now, like I said, this is just a debrief, just to show you what you're supposed to do. It's not really I'm not going to all the workings, but just to give you an idea of how to handle this in the exam. That will give you your NPV, which will be the answer for the first part, the value of the project, without considering the offer that they have. All right, so if you go to the next part of the question, we've done part 1. We have estimated the value of the project before considering the offer from DNT. The second part is if you consider the estimate of the project taking into account the value of TNT. Now, come back here, then Nivil Dynamic Tech has an offer. What's their offer? They have offered to TAS that they're willing to purchase the entire project for how much? 38 million at the beginning of year 3. So it simply means that here we have an example where we have an option that is embedded in the project. And we said for options, there are a couple of things you must know. For when you have option, number 1, you must understand the type of option it is, and you must be able to identify the key variables that make up the Black-Scholes model. So in part 2, basically here we have a real option. So part 2 is we have a real option. What is it? It's an offer to sell the project at start of what? Year 3, which is the same as end of what? Year 2. So importantly, what you need to do is to identify the type of offer. This is the offer to sell. Offer to sell. Offer to sell is similar to what? To a put option. But what we need to do is to identify the variables of the Black-Scholes. There are 5 variables. The variables of the Black-Scholes model, you must be able to identify them. There are 5 variables. The first one, of course, is the PA, the value of the underlying asset now. Then we have PE, the exercise price. We have, of course, the time for the option to expire. Then, of course, you have the standard deviation, which is the measure of volatility. And of course, we have the risk-free rate. All right. So these are the options, the variables that make up the Black-Scholes option. Most of them are very straightforward for you to understand, to pick up. Like time to expire, these are 2 years because we have to make the decision at the end of year 2. Volatility of the cash flows, this has been provided, 40%. Risk-free rate is 3%. So this is 40%. Risk-free rate is 3%. So what you need to do is determine the value of PA and PE. What's PE? PE is the exercise price, the price at which the option will be sold. And in this example, they've told us the project will be sold at a price of 38 million. This is our 38. What's PA? The value of the underlying asset. The underlying asset of this project are the cash flows. But we need to get the value of the cash flows that will be sold. And these are cash flows from what? From year 3 to year 4, because this is happening at the end of year 2. So what you're saying is basically cash flows from year 3 up year 4. So this is the value of the cash flows now. Now simply means we have to get that, their present value. So you simply come and add up here the present value of the cash flows from year 3 up to year 4. It should have been this. I'm just showing you what to do. All right, so that will give you the value of, if I just put this in millions, just for heaven's sake, we'll leave it like that. Now, in the exam, like I did say, is that you'll of course have the calculator, Black-Scholes calculator. So you simply come to the calculator here. Like I've said, what you need to do is just put in the values. The value of PA, the value of PE, which you said is 38 million. Risk-free rate, which you said is 4%. Time is 2 years, standard deviation 40%. So of course now you put in the PA. I'm just going to guess a figure. Maybe I'll say PA of maybe 35 million. It will give you what is D1, what is D2, and it will give you the value of the call, the value of the put. Our emphasis here, of course, is to get the value of the put because this is an offer to sell. So this is what we have done. So your work in the exam is really to understand PA and PE because the other variables are provided. But can you clearly identify PA, which is the value of the underlying asset now, and then PE, which is the exercise price at which the project will have to be sold? That is quite clear because here it's clearly stated as 38. What will confuse the most students to get the value of the underlying asset, which is basically what is being sold. We are selling the cash flows of the project, but starting from year 3 going forward. All right. Quickly, we'll go to the next part of the question, which is, and we've mentioned this several times, this will always be a question. The examiner will test your understanding of in terms of how you look at issues, in terms of skepticism, how skeptical are you? So most times they'll ask you assumptions. If they don't ask you about assumptions, they'll ask you about the uncertainties. So you must be able to discuss. We have gone through this a couple of times. You must know the assumptions that have been made. Quite a number of assumptions have been made to arrive at these figures. We have assumed what the prices will be. You have assumed what the inflation will be. You have looked at the assumptions in the Black-Scholes model. So you must understand that in case the assumptions change, the values that we have here will definitely change. So you must be able to look at it and be very skeptical that you have arrived at a value. These are the assumptions I've used to arrive at this value, but these assumptions may hold or may not hold. And in case these assumptions change adversely, this will be the impact on the project. Lastly, part number 4 is talking about business risks. So you must have known that at the beginning, this is an international investment. So you must know what are the risks that are associated with international investments. Number 1, of course, there will be issue of we have seen, of course, the exchange risk issue. There will be issue of course cash flow restrictions. There will be issue in terms of taxation. There will be issue in terms of the structure and resources in where you're going to invest. I think, is there enough proper labor? Is there enough infrastructure there? Will they take up the products? So there are a couple of issues that you can clearly pick out here. So these are some of the free marks that not free marks, but easy marks that the examiner always throws out there. So for part in this question, if a student had identified correctly that this was an international investment, it would have made your work much, much easier. So it's very important that at the beginning you understand what type of question is being asked. And then at that point, it will set you out on what to do next. Right. So this is just a debrief, so I'll not go into so much details, just to give you a head start. I'll quickly go to parts section B. Section B, of course, the first question here we have is on risk. And if you can see, we've been told we have 3 exhibits, transaction information, hedging information, director's opinion. So quickly, I'll just go to the information quickly, what it's about, so that you see. So right now is what? 1st of November. This company expects to receive a much? 35 million. When? On the 1st of March. So right now we're in 1st of December, X5. They expect to receive some money on the 1st of March, X6, and then they want to invest it for, it will be invested until it's needed. When is it needed? It's needed on the 1st of September. So here we have, and like I said previously, in most cases, students are used to a borrowing scenario. And sometimes when you give them an investing scenario, they just switch off. But remember, what you do for an investment scenario is simply the opposite of what you do for a borrowing scenario. All right. What hedging information do we have? They've given us that the company can invest at the central bank rate 3.5% currently. And when they're investing, they invest at the bank rate less 30 basis points, which is 30 basis points the same as 0.3%. Don't forget that. But what you predict is that the rates will go down by a much of 0.7% in the coming months. So what do you want to do? Number one, you don't hedge. You simply sit back. Number two, you use interest rate futures. Number three, you use options on interest rate futures. These are the hedging instruments that we have. Of course, then we have director's opinion that have given us. What are the opinions? Director A, Director B, Director C. All right. What are the requirements? So before you even go to the requirements, you now know that here we have a risk management. What risk? We're looking at interest rate risk. What's the scenario? We have an investing scenario. So when you come down here in the requirements, so now they tell us based on the hedging strategies. So here are 2 hedging strategies. You can either hedge using interest rate futures, or we can hedge using options on interest rate futures. Now, at this point, I expect that you have a proper understanding of how we hedge. You must have a proper understanding. How do we hedge? All right. Actually enough, this is it's quite straightforward. They're just asking you the hedging techniques. How are you going to hedge using futures? How do you hedge using options on futures? So if I come back here, I'll just quickly this is our question number 2. This is basically about hedging. And we have 2 instruments of hedging in this question. We have interest rate futures and options on interest rate futures. Now, like I said earlier on, it's always good that you summarize the information. You must get the basic information. The basic information I've just laid out here so that you get prepared for what to do. Number one, you must know the date now. Date now I've been told is 1st December X5. Date of transaction is 1st March X6. What's the type of transaction? We are investing. What's our fear or risk? Our fear or risk is a decrease in interest rates. What are we going to hedge? Hedging instruments we're going to use will be to apply either futures or options on futures. Now, we did say that there are 5 steps that are easier for you to work through. Just 5 steps. If you know those steps, it will be very simple. Step number 1, and it's the same approach we use. Step number 1 will be basically the type of futures. No, not type of futures. Step number one will be which futures. And because we're dealing with interest rates, our focus is on the debt. This will be the focus on the debt. So if you go back to this information, we have two. If you come back to the information provided about the hedging information, we have futures for December X5, March X6, and June X6. But we said when you're choosing the date, you choose the one closest to the transaction date when you open and still open. So our transaction date is March, so we are going to use March X6 futures. Right. Step number two will be the type of futures. These steps are very easy to memorize, and I really encourage you to master these steps so that even the examiner will follow through what you're trying to do, type of futures. And here we're basically looking at how do we open and close. And you must know the rule. What's the rule? The rule is if I'm investing, let me start by borrowing. If we are borrowing, right? So let me just make this easier. So of course, when you talk about step number two, how do you open and close? There are three questions to answer. Question number one is when, how, and price. When do we open? When do we close? When we open now. When is now? Now is the same as 1st of December X5. When we close on the date of the transaction. When is the transaction happening? It's happening on the 1st of March X6. How? How here? We must know the rule. What does the rule say? The rule simply says that if I'm borrowing, I open by, or I open with, I open with a sell and I close with a buy. And the reverse is true if we are investing. If we're investing, we shall open with a buy, we shall close with a sell. This point is really just knowing what the rules are. So here we're investing, so we shall open with a buy, we shall close with a sell. At what price? We then get the opening price of the March futures, which is 96.8. This will be 96.8, but preferably you put it in the full amount, so you divide by 100 to give you 0.9068. And what price do you close at? This will become in step number 4. All right. Next will be, of course, step number 3, the number of contracts. Number of contracts. You must know the formula. Number of contracts is basically equal to our contract is basically equal to our exposure divided by the contract amount times the duration divided by the contract duration. So this is the investing duration. Right. So that's how we get our number of contracts. So in our example, our exposure, the amount of money that we have is given as 55. Just a second. Exposure is given as $35 million. The contract amount, standard contract amount, is 1 million. All right. The investing duration. Come back to what we've been told, that you're going to receive the money. We're receiving the money 1st of March. And when we need the materials, 1st of September. So that means that, and it's preferable you count using your fingers. So you have the whole of March, April, May, June, July, and August. So you have 6 months to invest the money. This is 6 months. This will be 6. Put them in years. 6 divided by 12. 0.5. And then the contract duration. Come back here. That information is provided. Contract duration, hedging information. These are the 3-month futures. So most times the standard is 3 months, but just for you just to be certain that's 3 months. So this will be 3 months. It will be basically 3 divided by 12. So that will give you your number of contracts. All right. Then we'll go to step number 4. Step number 4, of course, which is very critical, is how do you get the closing price? Step number 4 is our closing futures price. And this is where most students have challenges from. What's the closing futures price? All right. So what do we do? The closing futures price, we determine using remaining what? Basis, or we use the concept of basis. Basis simply means where you have a difference between the spot and the futures. So what we shall do is to start it at now, which is 1st of December, X5. So you ask yourself, what is the futures price? And here, to be specific, it is a March futures price. March futures price, this is coming from step number 2. Step number 2, you simply come to March futures price. You get step number 2, that's the price. All right, then you get that, the spot price. But you must know how prices are determined when you're dealing with interest rates. We say that pricing is determined as, if you remember, is equals to 1 minus R%. So now as we speak, the central bank rate is 3.5%. I hope you saw that. The central bank rate is 3.5%. So this will be simply equal to 1. Let me just put it here. To be equal to 1 minus 3.5%. All right. Right. So this is the basis. This is our basis. What's basis? We simply say the futures price minus our spot price. So we'll simply come and get this minus that. That's the basis. But we expect that because we're using March futures, we expect that on the 31st of March, what will happen? The basis will be what? 0. So we expect that this will decline. So we expect a decline. So the number of months from now, which is 1st December, X5 to 31st of March, X6. So just count again using your fingers. You have December, so these are 4 months. December, January, March, December, January, February, and March. So these are 4 months. So these are 4 months. We expect that this will decline gradually. So just say gradual or even decline. Evenly reduce by this divided by 4. All right. But our emphasis is to get the price when? Now, when we the transaction date. And transaction date is equals to 1st of March, X6. What's the remaining basis here? There's just 1 month remaining, so it will just basically 1 times the basis per month. And then, of course, we know what the spot price is there. we know that on the 1st of March, the bank rate will move from 3.5% plus an additional 0.7%, give us 4.2%. So expect that the spot price on that date will be 1 minus 4.2%. Of course, now we can work backwards by rearranging the formula and saying that in that case, this is our formula, if you remember. Basis equals futures price minus spot price. So you can make futures price the subject to the equation. In this case, futures price, if you rearrange this, futures price will be equal to the basis plus the spot price. So I'll simply come back and say the futures price here is equal to the basis plus the spot price, like that, right? So this is very critical for you at that point. Of course, once you've determined the closing futures price, then what will happen next is just to go to our outcome, which is step number 5. Our outcome when on the date of the transaction. So step number 5 is outcome when on the 1st of March. And there are two things that you look at the outcome. Number 1 would be, number 1 would be in the futures market. What is going to happen in the futures market is that has already been explained in step number 2. So I simply come back to step number 2 and copy this. I just copy this, and I can see we have now the closing price as that. And in this example, we buy at that, and we sell at this. All right, so now you compare whether you have a gain or a loss by looking at the price at which you sell and the price at which you buy. All right. So this is just to give you just a highlight, but you'll go back and work through this properly. Of course, once you've determined this is the loss powered per contract, so you can now get the total loss or gain. Don't forget the formula. Total loss or gain is equal to the number of contracts times the second right number of sorry. So this will our total gain or loss. Total gain or loss will be equal to the number of contracts times the contract amount times number of contracts times contract amount times the gain stroke loss times the contract duration. Normal contract duration is 3 months. All right. So this, just one adjustment. We expect that the base rate will, the bank rate will have come down by 0.7, not increased. Sorry for that. Supposed to be 3.5 minus 0.7, which would have given you 2.8%. I was just wondering where the difference was, 2.8%. This should give you 2.8%. Not 4.8, not 4.2. Here you'll have a gain. All right. So this is what we do for our futures. And of course, once you've done this in the futures market, you've got in the total gain or loss, you now go to the spot market. Spot market when? You now go to the spot market on the 1st of March. What happened on the 1st of March? On the 1st of March, we know that the bank rate has moved up to 4.2. So has come down. Sorry, not moved up. Has come down to 2.8%. All right. We know that the company invests at the bank rate minus 30 basis points, which is 0.3%. So this basically they'll be investing at this figure minus 0.3%. The duration, the amount they want to invest is how much? 35 million. The duration is how much? Our duration is 6 months, which is basically 6 divided by 12. That can give you what the interest income will be. The interest income, this case will be basically 2.5 times the amount times 6 months. And what will you do at this point? You will then add the gain stop loss in the futures market. All right. So this is what we'll have done. But for once you've done the futures, the options on futures is even much more easy after this, because for options on futures, what we'll then do for options on futures is that we're going to have our futures, but the underlying asset is our interest rate. We're going to have our options, but the underlying asset is our interest rate futures. These are interest rate futures. So in this case, underlying asset is the interest rate futures. The steps are similar, and I'll just copy them just to show you that the steps are similar. Step number 1 will be which options, not which futures this time, which is options. And here we're talking about debt. We shall maintain the same debt like we already have. We're going to use look at the type of the options that you have. If you come back to the options that you have here, you have where the options, the options, you have options for December, March, and June. So we're going to use March options already determined. Step number 2 would be the type of options, which will be basically, so this is type, not type of futures, but this time to be type of options. Basically, whether we're going to use a put or what, or a call. So this again brings you back to the rule. Put or call. You must know what is the rule. The rule is simple. Borrowing, we use put options. Investing, we use call options. So we shall come back to the example and say, okay, since we're investing, we're going to use call options. And now here we have 2 exercise prices, 96.4 and then 97. The exercise prices 96.4 and 97. So it's basically simply to say this is, we're going to use call options with exercise price equals to 96.4 and 97, like that. But remember, 97 is the same as, if you put it in full amounts, it will be 0.9700, while this one will be the same as 0.9640, like that. All right, so what shall we do at this point? So that's step number 2. Step number 3 is number of contracts will not change. It will be the same number of contracts as before. So this will be similar to as above. As above. All right. Step number 4 now is why there will be a difference. That step number 4, instead of having the closing futures price, our step number 4 would be basically the premium cost. Step number 4 is basically our premium cost. The premium cost basically looks at how much premium must be paid. So you must know the formula for determining the premium cost. So we basically look at premium cost is equals to number of contracts. Now let me just lay it out here. So we have 2 exercise prices. 96.4 and then we have 97. So P is equals to 96.4, and P is equals to 97. All right, so what do? You lay out number of contracts, contract amount, number of contracts that come from step number 3. Contract amount, you can look at these contract amounts are given as a million. Here it is, and these are 3 months. Option premiums and percentages. So we simply come here and say contract amount is a million. Right, so we shall come number of contracts, contract amounts. What we need next will be the premiums that are quoted. Remember, these premiums are quoted in percentages. So most times students forget to convert these are percentages. So we're using call options, and we're using what match. So we have 0.56 and 0.315. So 0.56, 0.56%. Most times students forget the percentage signs. And then the other one is 0.315. All right. Of course, the contract period is 3 months. Which will be basically 3 divided by 12. All right, so now you multiply to give you the premium cost. Total premium cost. So what the examiner always wants you to do is to determine the outcome, assuming the options are exercised. You simply come here and say step number 5 will be the outcome. Outcome. If options are exercised. All right. So we have 2 scenarios here. The 2 exercise prices. Right. So of course, here we are using call options. When you use call options, you have the right call options. Call options. We have right to buy the underlying asset when on 1st of March at the given exercise price. What is the exercise price? 0.9640 and then 0.970. That's the right that we have. We have used call options. It means we have the right to buy the underlying asset. What's the underlying asset? Our underlying asset is the March futures, interest rate futures, March interest rate futures. And their price, which is our PA, when on the 1st of March is given in what? Step number 4. That according from step number 4 earlier on, what was the closing futures price? It was 0.927. So you now compare. Do you exercise? You are right to buy. at the given PE. Of course, you know the rule for call options. Call options exercise if PE is less than PA. If you look at the first one, yes. Why? Because our PE is less than what? Our PA. You'll buy at 96. The value is how much? 97. So we make a gain. What's the gain? The gain will be basically this minus that. In the second scenario, you have to look at it again. Second scenario, we have a right to buy at 97. That's the exercise price. The underlying asset at what? 97.28. So we still make money here as well. So it will be basically this minus that. This is the gain per contract. So you can then get the total gain. And we shall use the same method. Total gain is equals to number of contracts times contract amount times the gain stroke loss times the gain times the duration. Right. And then what we do, in summary, it will be the same up. So we shall come back here and finalize. We shall do the outcome and say it's similar to what we did earlier on. That on the 1st of March, what's happening? This will be the same information. The bank rate is 2.8. We are investing at bank rate minus 0.3, which is 2.5. Amount is that. This is our interest income. So what do? We shall add gain in the futures market. And then we shall less that, less the premium cost. And this we do for the two exercise prices. 96.4, like that. All right, so this just give you the outline what it's supposed to do. All right. So I believe you can finalize the rest. At least you have now the skeleton of what you expect it to do. So I'll quickly move to the next bit, director's opinion. And here there are three directors. Director A says it's not, basically what Director A is saying, it's not important to hedge because these things will cancel out. But you know that if you have an exposure, if you don't hedge, you stand a risk that you may lose money. So sometimes, yes, in the long run, they may cancel out, but it's always important that you ensure that you hedge, that you minimize the loss that may happen. Remember, your objective is to make sure that you maximize the benefit for the shareholder. So it's very important that we hedge. Director B says they prefer futures because they're perfect. They guarantee the interest rate. Of course, futures is that they will guarantee the interest rate that you receive, whether rates go up or down. But the only problem in this comment is that they say we also don't need any cash. When you're dealing with futures, you will need money for margins. And then, of course, in case you need a margin deposit at the beginning to open the futures, and depending on how the rates move, either up or down, if you're making a gain or loss, you may need to replenish that, the margin account, assuming you're making losses. So, of course, that's the next part of the question is not, of the statement is not correct. And then Director C talks about options. It seems they would go wrong. Options are good. Options, basically, you protect yourself against the decrease in the rates, and in case rates go up, you can then of course take the benefit in case the rates move in your favor. All right. So that's what the examiner was just testing in the last part. So whether you understand the difference between whether you should hedge or not hedge, you understand how the futures operate, and then of course what do options mean. Options, simply when you buy an option, it simply means that you have limited your loss to the premium you've paid, but you've opened the possibility that in case it moves in your favor, then you can make a gain. All right. The next bit of the question, I'll just rush through it quickly. It's just talking about mergers and acquisitions. We have this company, and the company is called Makoso. Makoso wants to buy a company called Ade. When we have been given information about the shareholders of ADE want anything above 12% gain on the current market value. The acquisition details are provided. Number one, you can give them a cash offer of 10.5. You can give them, number two, 8.5 bond in exchange for 10 shares. Number three, you can do a share swap for you, an offer of 2 shares in Makos for everyone in ADE. So we have been given the information about the two companies, Makos and ADE, revenues, profit before income tax, profit for the year, profit before income taxes, right? That's it. And then we have non-current assets, current liabilities, reserves. That's it. So it's a basic income statement and balance sheet, briefly. And then we've been told what's happening is that the current share price is 5.5 for Makoso. These are listed companies. The average PE ratio is how much? 15. Both companies have the same nominal share price. Non-current liability is 8% for the bond, payable in 4 years, trading at 110. And then they expect that it will be synergies of 5 million if the two companies are combined together. All right. So what the examiner wants you to do quickly, just to discuss the potential reasons why the acquisition may not be successful. So here, this is just some free marks for you to understand why the acquisitions fail. There are a couple of reasons why acquisitions fail. Of course, it will depend on the price being offered. Are you overvalued? Can you able to generate the synergies that you think you'll make? Can you integrate properly in terms of culture, in terms of systems, in terms of processes? So that's what you should discuss about in part A. Part B just looks at the percentage gain for each shareholder of ADE under each of the payment proposals. So we've done something similar to this earlier on. I think if you remember, there's a question called SIGRA. Let's go back to our work. I'll just show you SIGRA. Something similar to this called SIGRA. I think it's this one. Let me just look for it. Mergers and acquisitions. Something very similar to this called SIGRA. Where's mergers and acquisitions? It's not clear. Second. Yeah, here it is. It's called SIGRA, where we wanted to get the gain for dental shareholder plan. Same approach, really. First was the cash offer, five per share. Second was the share swap. And of course, the third one was, of course, to do issue a bond to the shareholders. So quite similar to what we did earlier on. But let me just run through this one quickly so that you can see. All right, so those are the three payment plans we have. Number one, they can give them how much? Cash offer of 10.5. Number two, give them a bond. Number three, a share swap. Now, what you need to do at this point is to determine what is the current share price of ADE, which is not provided. So first things first, you must determine the current share price of ADE. ADE is the target company. So you go back to the information and see whether that information is provided. If it's not provided, then you have to think of how that can be determined. So if you look at that information, we've been given basically details about the income and then the balance sheet. And then what are we told? Current share price of Marcos, 5.5. Average price is, so here they've given us and ADE is in the protein powder industry where the average PE ratio is how much? 15. So we can simply get the share price of ADE now using the PE ratio. So but you must know that we can say that the share price of ADE will be equal to the industry PE ratio times the earnings per share. And the industry PE ratio is given as 15 for the protein powder industry. So what I have to do is get the earnings per share. Get earnings per share. Earnings per share, EPS, is equals to our earnings, which is profit after tax. Earnings profit after tax. Divide by the number of shares. So the profit after tax for ADE is given. If you just go back to the information provided, you will see the profit after tax of ADE is provided as, if you come back here, profit after tax of ADE is 1510. So you have 1510 here. And then we get the number of shares. Number of shares are not given directly, but you can know how to get number of shares. The number of shares basically would be, you look at the balance sheet. The balance sheet, the share capital is how much? 1,200, and then the nominal share is how much? 50 cents. So it will be basically 1,200. 1,200 divided by 50 cents, which is 0.5. This will give you the earnings per share. I'll simply come and get this, divide by that. Our earnings per share for a day is 0.63. You then multiply this with the industry PE ratio, which is how much? 15, to give you the current share price of 9.43, 9.44. This will give us our current share price. So this was very important, be able to determine the current share price. So now once you have the current share price, then you can look at the three proposals. Proposal number one is a cash offer. How much is it? They're giving us a cash offer of how much per share? A cash offer of 10.5. All right, cash offer 10.5. Proposal number two is a bond offer of how much? The bond offer, if you come back here, a bond offer of 8.5 coupon, redeeming what? In 3 years for 10 shares. So one bond for how many? For 10 shares. So for the cash offer, it's very straightforward because you have the cash offer of 10.5 and then you have the current share price of 9.4, so you can get what the gain is. So this is basically the gain will be, you will have a gain here of approximately how much? This minus this is the gain. And in terms of percentages, it will be this divided by that. So the percentage gains approximately 11%. All right, so this is current price. This is the gain per share. This is percentage gain. All right. So that is quite straightforward. For the bond offer, similar to what we did earlier on, is that you must determine the price of the value of the bond. So you must determine the value of the bond. What's the price or value of the bond? And we know how to get the price of the value of the bond. The price of the value of the bond, value price of the bond is equals to the present value of the what? Of the cash flows. How do you get the present value of the cash flows? We'll simply have your year here. You have the cash flows. You have the discount factor, which is equals to our KD. And then you have the present value. So this is they're giving them a 3-year bond. So it will be for 3 years from year 1 up to year 3. The cash flows, of course, it's a coupon of 8.5. So it will basically have 8.5 times 100, assuming the par value is 100, from year 1 up to year 3. And in the 3rd year, the bond is redeemed at par, unless stated otherwise. So this will be the cash flows of the bond. Then what do? You discount this cash using the KD. So when KD is not given, you must know what to do. If I take you back what we talked about these 3 scenarios the examiner will give you, but I'll just come back here so that you see. If I go back to bonds, the 3 scenarios that the examiner will give you, so you must know how to deal with bonds. What do you do when you have bonds? Just 1 second. I go back to our material. Bonds, the 3 scenarios the examiner most likely will give in is 8 of the 3. The second. These are the 3 scenarios. Scenario 1, where you have to get the market value, which is the present value. Scenario 2, where you have to determine the KD, we get the IRR of the cash flows of the existing bond. And in scenario number 3, where we have to get the coupon rate, which is basically we solve the equation and derive for X. So in this example, they've given us a similar bond. So we have a similar bond. There's a current bond that they have, and that bond is given. The current bond that the company has is provided here, that they have a bond of 8%. It's redeemable in 4 years. The price right now is how much? 110. And it's trading at what? Trading at 110. And of course, the par value is how much? 100. So this type of bond basically seems, you can use the IR formula here to simply come and say, you have a bond right now. If I was to buy this bond, I would buy it at how much? I would buy it at 110. 110. Sorry, 110. If I was to buy the bond right now, I would buy it at 110. And what would happen? If I buy that bond, it pays me a coupon of 8% and it will be redeemed after 4 years. Per. Basically, from year 1 up to year 4, I'll have 8% times 100. And then in the 4th year, what will happen? It will be redeemed at par. So what I'm trying to get here is get the IRR. It should be basically like that. So this will be the cash flow. So I simply come and use the IR formula in Excel. Get you the KD. So our IR is the same as our KD, right? So you simply come with the IR formula. List your cash flows like that. This gives us a KD of how much? 5%. 5.2. So I'll just come and discount this with how much? 5.2%. This will give us the price of the bond. Now remember that one bond is equals to 10 shares. So that means one share simply means that one share is equals to a value of what? 1 out of the 10 of the bond value. All right. Then of course the last proposal, number 3, is the share swap. Share swap. So basically here you get the current equity, you just simply get the equity value of Makoso, the predator. You then add the equity value of the target company, add it, and then you also add the what? The synergies. And the synergies have been given as 5 million. We have $5 million here. You get the equity value of the target company. We already have the current share price and the number of shares. You also have the equity value of the predator. The current share price of Marcos is 5.5. The number of shares are also provided. So here you simply get, this will give you the value of the combined, this will give you the equity value of the combined company. When you sum up these two, then you get the number of shares. You have the current shares of predator, and then new shares issued to the target company, which is what? Which is added, because we're doing a share swap. And of course, you'll now get, if you divide the two, it will give you the value of the equity value after acquisition. And then, of course, you can see what is the value of a share that Ade will get in the predator company. And the ratio we're looking at here is a ratio of approximately, the share swap ratio is given. It is 1 offer, 2 for 1. So do you get 2 shares in an offer of 2 shares in Marcos, so being equal to 1 share in Ade. So it's 2 for 1. So I'll basically say that 2 shares, rather, basically 1 share in Ade is equal to what? 2 shares in Koso. Like that. So it will basically times 2 times the price you'll get here. Then you can now get the percentage what? Gain. So basically, that is how you'd have worked through that question in part B. And of course, part C is which payment proposal would be most likely for Koso. Of course, Makoso there are three types of payments here. Number one, if they're to pay cash, the problem with paying cash, it simply means that money sometimes you need to preserve cash. Cash is very important for expansion. So sometimes you may not want to pay cash because you need to preserve that money for financing. So it may not be a very good offer. The share offer may not be acceptable by most shareholders because, of course, it will mean that you're diluting the shareholding of the current shareholders, so they may not be favorable to them. And maybe the bond offer may be feasible because the bond offer, you maintain the shareholding structure right now, and then of course you paid these people are paid at the very end after 3 years. So Makoso may prefer between the cash offer and the share swap. I think the share swap would be more preferable for them. All right. So, but like I said. And this has been demonstrated here that there are 5 marks for professional skills that you must demonstrate, and how you analyze, how you evaluate your skepticism and your commercial acumen in your answers. So make sure that you don't miss these marks. The way you reason, the way you outline your questions, the way you respond, the way you do your workings, all that will count to these additional professional marks that the examiner will give you. All right, so this was just a debrief. If you walk through this, in case you have any challenges, always please feel free to reach me. This is just an outline. I should give you a starting point and get you ready for the exam. But like I said earlier on, please make sure that preferably start with section B. The questions are short, straightforward, and you can work through them quickly. But just make sure that you time your work very well. 45 marks, 45 minutes, and then after 1.5 hours, it will be the time to move on to section A. Another thing is that try to get the small formulas at your fingertips because you may have the idea of what to do, but you may forget the formulas. So those small formulas should be at your fingertips otherwise. All right, so we'll take it from here. Feel free to get back to us in case of any challenges. Thank you.